The siren song of cryptocurrency promises unprecedented gains, a digital gold rush where fortunes are seemingly made overnight. Yet, for countless investors, this siren song often leads not to a treasure island, but to a shipwreck of devastating losses. Why is it that so many, despite their earnest intentions and careful research, consistently find themselves leaving significant money on the table in this volatile, psychologically charged arena? Benjamin Graham, the father of value investing, once observed that an investor's chief problem, and indeed their worst enemy, is likely to be themselves. This timeless wisdom echoes with an almost deafening clarity in the world of crypto. We're not merely discussing the inherent volatility that whipsaws markets daily. We are about to embark on a deeper journey, a forensic audit of the crypto landscape. We will dissect the specific, often overlooked data points that sophisticated Wall Street institutions, armed with their advanced analytical tools and a profound understanding of human psychology, expertly leverage. They use these insights to their advantage, while many retail investors, navigating the same waters, remain in the dark, their returns quietly eroded. This video is your guide through that minefield. We will uncover the 5 critical data points that are silently crushing your potential gains, revealing the hidden mechanics at play. Our aim is to equip you with the knowledge to not only understand these exploitative tactics, but to fundamentally turn the tables. Prepare to view the crypto market not as a matter of luck or chance, but as a system with discernible, exploitable mechanics. By the end, you will possess the tools to avoid becoming another statistic, to reclaim your agency, and to build wealth with informed, strategic intent. The first data point Wall Street understands, and you should too, is the illusion of on-chain transparency. Many believe that high transaction volume on a blockchain is an irrefutable sign of healthy growth and widespread adoption. It's a seductive narrative, isn't it? More activity must mean more value, more demand. But the reality, the truth that Wall Street's sophisticated algorithms and seasoned traders grasp, is that raw volume can be, and often is, manipulated or simply misleading. We need to dissect the critical difference between genuine value transfer and the noisy churn of wash trading or algorithmic shuffling. Think of it like a bustling marketplace. Every handshake, every exchange, every movement can be logged, creating an on-chain record of immense activity. A superficial observer, mesmerized by the sheer volume of handshakes, might conclude that this is a thriving economy. But a truly discerning bear, the kind Wall Street aims to be, looks beyond the number of handshakes. They scrutinize the actual value of the goods changing hands, the substance behind the activity. Wall Street is that discerning bear, sifting through the noise. This leads us to debunk a pervasive myth that more transactions inherently equate to better adoption. We will explore how large, seemingly insignificant transactions, often executed by bots or coordinated entities, can be strategically deployed to inflate perceived activity. This artificial inflation can mask a stark reality, a profound lack of meaningful economic utility or genuine, organic investor interest. They create a mirage of bustling activity to distract from the desert of real values. So, what's the actionable insight here? Learn to differentiate between mere activity and true adoption. This requires looking beyond the headline volume figures. Focus instead on metrics like unique active addresses, the average transaction value, and critically, the ratio of transactions to newly created addresses. These indicators help you discern projects with genuine utility from those whose metrics are artificially inflated. This is how you begin to spot the signal amidst the pervasive noise. The hidden truth is that while you're chasing the ghost of transaction volume, Wall Street is quietly using its advanced tools to filter out this noise, focusing solely on the signal of real economic value. The second critical data point that Wall Street masters is the misdirection offered by active wallets. The narrative of millions of active wallets is a potent one, a siren call that suggests widespread adoption and a thriving ecosystem. It plays directly into our deep-seated desire for validation, reinforcing the comforting belief that we are part of a massive, growing movement, a community of like-minded individuals building the future. But Wall Street understands a crucial, often hidden, truth. A significant portion of these so-called active wallets are anything but. Many can be dormant, holding positions from bygone eras with no intention of active participation. Others might be inherited digital relics or simply wallets where funds were once parked and forgotten, distorting the true picture of genuine network engagement. While the long-term hodl strategy is a legitimate approach for many, a high percentage of dormant wallets can signal a critical lack of organic growth. It can indicate a market dominated by passive holders, individuals less likely to react dynamically to market shifts, thereby creating a false and potentially dangerous sense of security. To navigate this, we must learn to unpack the hodl effect and look beyond the headline numbers. Analyze wallet distribution data, seek out the concentration of holdings. A few large, inactive wallets can significantly skew the active count, painting a deceptive picture of vibrant participation. We will explore how to access and interpret this data to truly gauge genuine user engagement rather than succumbing to the illusion of mass participation. The Wall Street edge lies in their ability to see through this facade. They don't just count wallets, they analyze the velocity of funds moving between them, the frequency of new wallet creation relative to older ones, and the precise distribution of holdings. This allows them to ascertain if a network is truly alive and dynamic, or merely a vast collection of digital mausoleums, holding assets with little to no active economic lifeblood flowing through them. This deeper analysis reveals the true pulse of a crypto project: market capitalization. It's the headline number, the figure plastered everywhere, the seemingly definitive measure of a cryptocurrency's size and importance. But for those who understand, and certainly for Wall Street, this headline number is often nothing more than a mirage. They understand a fundamental truth that eludes many. A high market cap does not automatically equate to high liquidity or a stable, genuine circulating supply, especially in the often thinner, more volatile crypto markets. Consider this symbolic provocation. Imagine discovering a magnificent mansion situated on a deserted island. Its perceived market value might be astronomically high, a figure that turns heads. But try to sell it quickly. Try to realize that value. The real liquidity is likely near zero. You're left with an impressive valuation, but no actual buyers readily available. Wall Street, in its strategic pursuit, is constantly looking for islands that have not just impressive structures, but actual, active buyers and sellers milling about. This brings us to the often shady realm of supply manipulation. We will expose how circulating supply, that crucial component of market cap calculation, can be artificially inflated or deliberately deflated. This is achieved through various mechanisms: staggered token unlocks that flood the market, aggressive vesting schedules for early investors, or even sophisticated market-making strategies meticulously designed to create an illusion of liquidity. These tactics make a project appear far larger and more stable than its underlying reality. Therefore, your actionable strategy must shift. Stop fixating solely on the headline market cap. Instead, focus on the free float market cap and, critically, the depth of liquidity. Learn to meticulously analyze order books, observe trading volumes across a diverse range of exchanges, and assess the maturity and integrity of a project's tokenomics. Understanding these elements will reveal the true market depth and a project's resistance to manipulative forces. The underlying truth, the one Wall Street operates on, is that they don't just look at the price tag. They assess the actual cash in the bank and the ease with which they can buy or sell substantial quantities without causing seismic price shifts. This is a crucial distinction that many retail investors tragically overlook. Social media buzz, trending hashtags, the sheer volume of excited chatter can create an intoxicating illusion of demand, a powerful narrative of a project on the cusp of greatness. Wall Street, however, operates with a different set of priorities. They understand that sentiment-driven rallies, fueled by collective enthusiasm and the ever-present fear of missing out, are often fleeting and unsustainable. Their focus is firmly fixed on data that reflects not just chatter, but actual product usage, tangible adoption, and genuine utility. Consider the timeless parable of the emperor's new clothes. Everyone in the kingdom talks about how revolutionary and magnificent the emperor's new attire is, how it signifies his power and wisdom. But when you look closely, when you search for the actual clothes, they simply aren't there. This is the paradox Wall Street exploits in the crypto space. They are often the one voice, armed with data, brave enough to point out that the emperor is, in fact, naked. We must learn to debunk this FOMO trap, this pervasive fear of missing out. Coordinated social media campaigns, often amplified by influencer marketing, can artificially inflate sentiment. This manufactured excitement drives retail investment, frequently at the very peak of a hype cycle, when the risk is highest and the potential for loss is substantial. The narrative is crafted to make you believe you must act now or be left behind. To counter this, develop a practical framework, a sentiment to utility ratio. Learn to meticulously cross-reference the roar of social media mentions with concrete metrics. Look at decentralized application, or DAPP, usage, the levels of developer activity on GitHub, and the substance of partnership announcements. If the social sentiment is soaring, but the underlying utility and adoption metrics are stagnant or declining, that is a significant red flag. The sophisticated investor's approach, the Wall Street edge, is to use sentiment analysis tools not to follow the herd, but to identify potential overreactions and critical divergences between public perception and the project's underlying fundamentals. They seek the substance beneath the spectacle. The final, and perhaps most insidious, data point Wall Street leverages is its advantage in navigating the complex web of regulatory ambiguity inherent in the cryptocurrency space. For the retail investor, this uncertainty often feels like a minefield, a landscape fraught with unforeseen risks and confusing rules. Wall Street, however, with its formidable legal teams, vast resources, and intimate understanding of financial frameworks, frameworks can often navigate this uncertainty with relative ease and, crucially, can even exploit it to their profound advantage. This creates a significant cognitive dissonance. On one hand, we have the core ethos of crypto: decentralization, permissionless innovation, and a break from traditional, centralized financial systems. On the other hand, we have the reality of how these assets are increasingly interacting with and being scrutinized by a highly regulated global financial order. Wall Street bridges this gap using resources, connections, and expertise simply unavailable to the average individual investor. They can afford to hire the best minds to interpret, anticipate, and sometimes even influence regulatory changes. We must reveal this Wild West advantage, understand how certain entities, often those with ties to traditional finance, can operate with less scrutiny, leverage existing regulatory loopholes, or strategically position themselves to benefit from anticipated regulatory shifts. This creates an undeniably uneven playing field, where being ahead of the regulatory curve becomes a powerful tool for profit. While you, as an individual investor, cannot match Wall Street's legal power or its deep regulatory connections, you can arm yourself with informed awareness. Understand the evolving regulatory landscape in major jurisdictions. While you may not be able to exploit loopholes, this knowledge allows you to identify projects that are proactively addressing compliance and building for long-term sustainability versus those operating in high-risk territories with uncertain futures. The ultimate hidden truth is that Wall Street isn't just analyzing charts and sentiment. They are constantly analyzing the rules of the game itself and how to bend them to their strategic benefit. This is an advantage that significantly impacts returns, a crucial factor often missed by those focused solely on price action. We've journeyed together through the intricate landscape of cryptocurrency, dissecting not just the surface-level price charts, but the deeper, often hidden data points that Wall Street expertly leverages. We've examined the illusion of transaction volume, the deceptive allure of active wallets, the mirage of market capitalization, the paradox of social sentiment, and the strategic advantage of regulatory arbitrage. These 5 points aren't just abstract concepts. They are the very mechanisms that can turn a promising investment into a crushing disappointment. Recall the wisdom of Warren Buffett, a principle as vital in traditional markets as it is in the volatile realm of crypto. Rule No. 1. Never lose money. Rule No. 2. Never forget Rule No. 1. Applying this fundamental tenet to cryptocurrency demands more than just hoping for the best. It requires a rigorous, almost surgical, analysis of the underlying data, moving far beyond the seductive, yet often misleading, price charts. True success in this space isn't about blindly chasing the next perceived moonshot or getting swept up in the latest hype cycle. It is about a profound understanding of the underlying mechanics, the data that truly matters, and the psychological pitfalls that are so expertly exploited by those with greater resources and insight. The key takeaway from our exploration is this: empowerment through knowledge. By shifting your focus from fleeting hype to genuine utility, by scrutinizing true liquidity and engaged user activity, and by maintaining a realistic assessment of the evolving regulatory environments, you can begin to construct a crypto future that is not dictated by chance, but built on the solid foundation of data-driven fortitude. This is how you move from being a passive participant, susceptible to market manipulation, to becoming an active, informed strategist. Your next step, therefore, is to internalize these analytical lenses, apply them rigorously to your current crypto holdings and to any future investment considerations. Challenge the prevailing narratives, question the glossy metrics presented to you, and begin to make decisions based on verifiable data, not just the echoes of market sentiment. This is the path to building your crypto fortress, a resilient structure designed not to be swayed by every market gust, but to stand firm, grounded in truth and strategic understanding.